So this session plans to focus and highlight challenges and opportunities in India's dynamic financial inclusion ecosystem. And we are very delighted to share it with you all. Ladies and gentlemen, we are all set to start this session. May I invite on stage the esteemed moderator and the esteemed speakers of this session. This session is being moderated by Mr. Abhishek Anand, partner, Microsave. May I request him to please join us on stage. Please join me in welcoming Mr. Ankur Bansal, Managing Director, Black Soil Private Limited, Mr. Aditya Mohan, Investment Officer, FMO, Mr. Akshay Gujar, National Business Manager, AU Small Finance Bank. I'll request them all to please join us on stage. A very warm welcome to the esteemed panelists and the moderator of this session. I now hand it over to you, Mr. Abhishek Anand, the moderator of this session.
Thank you so much. And thanks, everyone. It's been an eventful 2 days. Last but not the least, we'll have a very important discussion. And I have investors with me on this panel. Just to set the context, microfinance sector is one of the largest microfinance program in the world. Very important sector in terms of financial inclusion, and it provides impetus to the overall economy. So, and we see that though the sector is very important, it's become pretty big, it has also gathered a lot of visibility. There are these leading financial institutions, many of them are listed. Every small event makes a big news in newspaper, it comes on television, there are listed companies as well, so people follow it. Now, there used to be some challenges or crises every 5 years. We are seeing challenges happening, now much more frequently. Of course, there are issues and challenges around product development, around model, lending methodology, and underwriting. From the governance point of view, maybe I would want to start, let's say, with Ankur. What kind of investment philosophy you have, what brought you into the impact sector, especially in the microfinance?
Yeah, thanks for having me over, Abhishek. So unlike a lot of the other folks here, we at Black Soil actually are more our accidental investors in this space. Our roots have been more towards the startup ecosystem. We have actually financed more fintech companies before we ended up getting into microfinance. And the reason the transition happened was that we realized post the initial COVID period and lockdown period, and once the things started, stabilizing, that this was a asset class which we could look from a risk perspective very differently versus a fintech business, where there are branches, there's connect with the customer, do you know the customer very well? Technology is definitely missing. But there are ways of sort of, understanding about how do you underwrite this customer base, how do you build a business around it, and at the same time, the loans are given for creation of livelihood. In the most fintech, the generic phase of 2020, 2019 was more for personal consumption and, not necessarily for creation of livelihood. So this changes dramatically when you look at the traditional NBFCs that have been there for a very long period of time. And that's how the transition started. And we have now ended up financing core to more than 40 to 50 odd NBFCs who have been sort of looking for debt capital to be able to keep growing for an onward lending perspective. So microfinance has been one of the key recipients for that capital. And obviously, we ourselves are an NBFC. Cost of funding itself is an issue for us. So the kind of NBFCs and mainly microfinance businesses we've been funding have been anywhere from an AUM of like 50 to 70 crores up to like 1,000 crores. So these are all rated NBFCs, profitable, been in business for possibly 5 to 10 years, have gone through the period of COVID, where you get a very interesting data point about how they went about a phase that nobody really knew about how you go about collections, how did you behave with your clients, how did you behave with your lenders, what was the skin in the game from relevant parties, and how they were able to bounce back after that. So with that data point being in place, plus the business was on the obviously on the curve of growth, and we were not the first lender. In fintech, we were typically the first 3 lenders, first 5 lenders in the space. So a lot of credit history is already established. And when you go on ground, you can meet the customers. You can see what they're doing. You have a lot of data around the sector. So we are relatively the youngest or the earliest player, not the earliest player, the latest player in the microfinance space, right? A lot of the other segment, people have been lending for decades in this space. So you can learn, have a lot of learnings, use that to be able to develop what kind of businesses you want to fund. And as a lender, we have the flexibility of time, as in terms of that we are not here for 5 years, 7 years, 10 years as equity investor. As a lender, your horizon is 18, 24 months, sometimes even shorter. So you get an experience after lending how the process and systems are. What is the transparency? How accessible the management is? How good the information systems are? How much they are able to explore and understand the growth of the business. And as you start lending more in a certain segment, we get a lot of data. And then we end up comparing a lot amongst the performances against various states, what is happening. And the last 9 months has been very starkling difference versus what it was in the heydays of last year or before that. Now the reality is sort of kicking in. Now you start to see whether the quality of collections is there, whether you're talking about growth or whether you're talking about maintaining the book, whether you're able to get your liability profile well, are you able to collect, are you able to communicate to all the lender base. So that helps us to decide who do you want to continue working with, or whether there's or whether you want to continue to exit a position. So you have to reshuffle the portfolio over a period of time. See, ultimately going on the field, meeting the customers, see what is changing. Everybody understands there is a change happening. There are multiple reasons, sometimes excuses. So you have to be able to differentiate between them and then come to a conclusion where how you want to support some of these companies. So that's what we've been sort of doing in the last few months.
Right, right. And Aditya, I mean, FMO is a pretty well-known organization across the globe, pretty respected as well in terms of the attention you bring to the impact areas, especially banks and microfinance institutions world over, and we've seen your work. So what has sort of brought you into the inclusive finance space, and what are your objectives when you make those investment decisions?
Sure. Thanks, Abhishek, and thanks to the organizers for having us here. I think from FMO's perspective, look, I think we have been investing in general in India for multiple decades and also across the globe. And I think we have also seen the evolution of our portfolio from, let's say, I think in general philosophy for DFIs is that the financial sector or banks are the easiest way to access development or to finance development in emerging economies. So I think that's where the journey started. And subsequently, we have seen that, look, this is not enough. Providing access to capital to large banks is serving sort of a very small niche. And then you say, okay, that job is done. So how do we create more impact? And that's where I think financial inclusion or microfinance comes to the fore. This is a sector, of course, that, the objective as a DFI is to create impact, and here the impact is to provide access to finance to those who don't have it. And I think there are two aspects to microfinance, I think, that contributed to, let's say, an impact investor's motivation. So one is, of course, the rural areas where incomes and access are low. And secondly is also the gender aspect, right? So I think microfinance has been predominantly women. And this is, a sector which historically hasn't had as much access to financial services, and it acts as a tool of empowerment. So I think that was sort of FMO's, attraction to microfinance. And I think another crucial aspect, and this is, so I think that's, I was saying that, we did speak about the gender aspect of microfinance being a key attraction. The other key attraction, of course, is the ability to absorb a certain volume of capital. As foreign investors and investors in general, institutional investors, you require a certain minimum viable check size for the investments to make sense, unlike the retail side. So I think microfinance was at a confluence of several of these factors which made it attractive. Of course, I think, on the other side, especially from an equity perspective, India is sort of an exemplar in also providing liquidity to investors in terms of various successful IPOs of microfinance companies. So I think that's the other motivation, either by way of IPOs or by way of mergers. I think we have a large enough market for it to be attractive. So yeah, I think in summary, I think I would say, impact in terms of access and gender coverage, scale to absorb the desired amount of capital, and the ability to provide liquidity to equity investors sort of attracted us to microfinance.
Interesting. So moving to Akshay, I mean, your organization is pretty well known in terms of, its a rural play, and it's one of those institutions which has mastered how to be a financial intermediary in rural landscape. And soon, I mean, and congratulations, we soon should be a universal bank as well. What has brought you into the rural finance sector, one of the harder ones, and what were the objectives in terms of financial inclusion for your organization?
Yeah, hi. Thank you. So, as a DNA, I feel AU has always been funding into rural space, and that is a space that we truly enjoy, predominantly because that is where you get to do livelihood enhancement. So, our funding principle has always been that if you give out money, loans, that loan should be able to at least enhance the livelihood of that person, should be able to create some kind of asset and some kind of income out of that, right? So microfinance now with the merger of Fincare is a big thing now that we are doing, and with all of that, other cattle funding, FPOs, through which a small ticket loan can be penetrated into rural India, is something that has now become a group, and that is what we are truly doing. That with all of that, I also feel that a lot of scope is still there in rural India, right? We should not shy away, and should not also not be scared with the recent challenges that the industry is facing. And I think we should still go ahead, and that is what we are largely doing. We are recalibrating our on-ground strategies, and I think that's the way forward for us at least. Yeah.
Right. So now, currently we are in the midst of some headwinds as a sector. Has there been a change in your investment thesis or overall investment philosophy? Of course, there's a lot of discussion around climate change and gender. MSMEs are back in focus after a while again. So any change there that we would see going forward in terms of investment philosophy?
So actually, there is a change happening. Not that we had thought through it, but looking at the quality of deal flow that we are getting, we are seeing now, as you rightly mentioned, MSME taking a more larger share in this. And in MSME also, there are 2-3 segments that we are seeing. So there is one, the traditional gold loan space. The second, that is basically asset-backed. Second segment we are seeing is the unsecured MSME space, where again it is interesting because a lot of new NBFCs are being set up, who are setting up their branches using technology first as a thought process and going to the microfinance plus customer. So the customers who are now supposedly graduating from that segment, and there is a large requirement into 1 to 3 lakh rupee budget, 1 to 3 lakh rupee ticket size to give those 1 year, 2 year kind of loans. Some of it could be kirana store, some of it could be trading, some of them could be poultry, etc. And many NBFCs are coming up with specific segments that they are able to identify and keep like 30-40% segment around that sector that they know at. And on top of it, now the latest fad that has come into the segment is micro lab, where people are saying, again, this customer, if I go to the next level, so where there is an asset, you give a longer tenor debt, and at the same time, you're sort of not taking that kind of risk, right? Because today unsecured has become obviously sort of not the word that everybody wants to be associated with. So more and more transactions are going in that direction. The third space we are seeing a lot of action again is around the vehicle financing, So used vehicle financing, two-wheeler financing, EV vehicles financing. So a lot of the other products where again there is an asset back collateral which is coming into the picture. A lot of the business is still growing on that segment. A lot of the traditional vehicle financing are also getting into the EV space because they're seeing that also as a segment. So ultimately, the customer is a micro entrepreneur or a nano entrepreneur, maybe a owner of a fleet of 3 vehicles, 5 vehicles, etc. Also is coming into the being. So there is a lot of such businesses coming. They are also growing well. Stress in that segment seems to be relatively lower today. It's only today we don't know because a lot of these are still very early stage companies. Some of them have been there for a decade plus, so there is a lot of data to still look at. But a lot of the other competing businesses are there in the same segment from a financing perspective, that it is not just MFI which is taking off the lion's share, but you have other segments to go to. So if one segment is struggling in collections and the PAR data or the NP data is increasing, then you sort of want to wait it out, see how the performance is for 2-3 quarters before again doubling down on any client.
Right, very interesting. So, Aditya, same question to you as well.
Yeah, I think, look, I think, of course, I think there is sort of, when microfinance has been a kind of a cyclical business where we have seen multiple crises, right? So, be it the Andhra crisis or, early crisis. So I think you come to see that, at the time of every crisis, there is sort of a cleanup of the sector that happens. And I think the key question again that we have in microfinance that's staring us now is that, look, what's the optimum scale of a microfinance institution? So we expect at least some consolidation, etc., to happen. So I think scale and size becomes critical because you have to be efficient. If the regulator is concerned about, your pricing, etc., I think that's something to take into account. But in general, I think from a theme perspective, MSME, while the unsecured side, I think still continues to be challenging. Though we have had the JAM Trinity, which has made data much more sort of accessible and sort of data much more widespread in terms of usage, tax records, etc. I think, but the jury is still out in terms of executing well on unsecured MSME loans. However, the secured side, the micro lab that Ankur also referred to, looks quite promising. Additionally, affordable housing finance companies have actually done really well, and that's an area that has got attention. But in terms of more risky capital or catalytic capital that DFIs seek to provide, I think the additionality in terms of the climate transition is something that everyone is focusing on. So even for a DFI like us, yes, I think we would like to finance these sectors. Like to finance microfinance or as SME finance. But if we are able to demonstrate additionality in terms of climate change mitigation or enabling the transition, we are able to provide more catalytic capital in such sectors and such spaces. So I think the risk tolerance and appetite on those kind of themes is much higher than for mainstream microfinance, though we continue to invest in microfinance as well.
Interesting. So, in terms of catalytic finance, in order to establish additionality, do you think the investment institutions which are focused on investments are ready with those tools to establish, for example, let's say the money has to go into climate related activities, whether investment tools are available in terms of gauging the outputs, outcomes and impact numbers?
Yeah, I think yes, I think there is some amount of data information that we have historically had, in terms of, CO2 emissions, etc., which there is some general level of reporting that is possible at this point. But I think, typically these were very small portfolios of large institutions, right? So you're having a 1,000 crore portfolio, of which maybe 50 crore is in some kind of impactful, like in, let's say, climate transition. So it's not so material. So you could sort of develop bespoke reporting. But increasingly, we are seeing specialized lenders who focus exclusively on, say, some kind of climate mitigation on different axes, like, let's say, rooftop solar financing or EV financing or some of these fronts. So there we need much more detailed reporting, and there needs to be, there is still room for harmonizing data across these various products. Earlier, like, microfinance institutions selling just a solar lamp was very easy to quantify. It's one product, small portfolio, you could do it. But with increasing diversification, I think that challenge remains. And I think on the other side as well, when we are looking at catalytic finance, the gap remains in terms of ability to structure, let's say, blended finance transactions. There are regulatory constraints to how much and how we do structure catalytic finance. So I think that constraint also remains apart from the data constraint at this point.
Right. So Akshay, one question to you, just slightly tweaking the same question. In terms of diversifying, moving into different market segments, do you have a gender intentional sort of a policy, sort of more guided and intentional push towards giving loans to women, focusing more on climate change, and that investment needs to move towards mitigating climate change? So do you have a more intentional kind of a policy on this?
Definitely yes, and the reason for doing that is there are a lot of other areas where women have been excelling and have been doing different kind of livelihood enhancement kind of work. So I'll give an example. What we recently did in a location known as Parli in Maharashtra, Aurangabad, we had a ground partner by the name of GVT. So GVT works on sericulture. So a lot of women farmers there who were also part of the microfinance unit largely, but they were trained on sericulture farming. And so that GVT was a ground partner and we became a funding partner. A 2 lakh rupee loan was given to them. And traditionally, those farmers or ladies largely were cotton pluckers. And suddenly now have moved or made a transition into sericulture farmers where the annual income is in the range of 2 to 3 lakh rupees. So women definitely yes, but with all of that on the diversification side, if we are able to have a ground partner who is on the ground, hand holding, teaching from A to Z, then it becomes much easier to diversify also, and then hold hands of ladies or women for that matter. So with microfinance, these are other things which I feel is the next big thing, which will again push the microfinance industry up again.
Right. So this is now pertinent. So, I mean, my next question would be, technology plays a very important aspect in financial inclusion. And we are seeing a lot of new innovation that is happening, a lot of work around farmer stack that's happening. Government of India is pushing it, and we're seeing some good results coming in Bihar and elsewhere. There's a lot of work around account aggregator that's happening. There are institutions which are using satellite imagery to engage with farming community. I mean, this whole lot of data that potentially could be made available to banks to underwrite agriculture loans going forward. There's also discussion around and some concerted effort around probabilistic cash flow based lending in India. Now the question is that we have a very human intensive traditional microfinance program, and then we have fintechs also coming in, more digital native, technology first kind of institutions. Do we see a competition, a more aggressive competition happening in this sector, or do we see areas where collaboration could happen?
So I will just pick up where my esteemed panelist just left, and I'll add to what you just said, and I'll bring in what we are doing at Black Soil. So apart from doing direct lending to NBFCs, we also 3 years ago started a supply chain platform. And the reason we started into it was because one of our startup client, Dehat, who's a large agri input player and output market linkage player, said they needed financing for their farmers and also needed farmer financing for the retailers who are buying from Dehat. And we ended up constructing a sort of a three-way partnership where we are able to lend to farmers, retailers, using Dehat as the anchor. and also using the collection force of Dehat on ground to help us collect that against the invoices that were being raised by the retailers. So this sort of helps to sort of create a closed loop financing where you're seeing the performance of the book very quickly because it's a 90-120 day product. You know what the usage is for. There the chances of fraud very low because it's not a farmer is walking into your office. It is coming through a very strong anchor partner, and at the same time the money is utilized for further livelihood, right? And suddenly this is the kind of programs that many of the startups are able to create or want to do in the future because they are not credit underwriters but they are sitting with multiple agri players, FPOs, suppliers of capital, or people who are consuming the agri products, and they're looking for solutions where, at different value chain point, credit can be provided to people in the value chain system, and that's where fintech can comes in the middle, or traditional lenders can come in the middle alongside with these players and create some of these credit programs. We have such similar credit programs running even for in dairy space as well, right? So you're buying, vendors are buying the milk from farmers, supplying to a large milk producer. The vendors want money on time, right? For the biggest problem for a lot of the MSMEs is getting capital, getting payments on time. So an NBFC partner can take that credit risk, can underwrite using all the digital footprint that is there. At the same time, the data the anchor also provides, and at the same time create that kind of a customized program, on the back of which large banks can come as co-lending partners, right? Because it's not easy to keep creating a scalable program. So you need to have those on-ground partners that you mentioned example, right? So you don't want to do it one-off. You want to create multiple such situations where companies are looking for such smart fintech companies who can come in, plug in the gap, at the same time open the entire platform for larger and more cost efficient providers of capital like large banks coming in and providing that much cheaper financing for the end user of it. So this is the direction at which some of the things we are at least already been doing at Black Soil, and we are seeing similar examples at many other places and a lot of other segments around MSME segment as well, where startups are at the center of it because they are dealing with an ecosystem for a while and they want to provide credit to them. Today, startups are able to get credit, especially the ones who are already well funded on the equity side, but they want to provide ecosystem financing as well. So where this is all either could be an agri player, could be an MSME, could be any vendor, etc., and they want to consolidate that and provide credit to them. So that's where the difference of embedded finance is sort of coming into the picture.
Right. Aditya, your opinion?
Yeah, I think as far as competition is concerned, I think look, there is the line between an NBFC and fintech has been increasingly blurred. Quite often, the same company, when they talk to lenders, they call themselves NBFCs. When they talk to equity investors, they call themselves fintechs, right? So it's just a question of positioning. But look, ultimately, it boils down to what is your core business, and there, if the answer is that your core business is that your income is going to come from credit, then you have to be an NBFC or a regulated financial institution. There is no way around it. So it's as straight as that. However, where the kind of partnerships and convergence that Ankur and Akshay spoke about come into play is if credit is not your core business, then it makes a lot of sense to partner with other lending companies. So in summary, look, if you're a fintech and lending is your core business, then you will just be an NBFC by default. And if you're a fintech and lending is not your core business, then you have to partner with an NBFC to make it a success. So I think that's how I would see it.
I feel rather than competition, it is more of about collaboration. I have a little unpopular opinion here. I see a lot of startups or fintechs who are working with banks or pitching to banks are largely talking about faster TAT or talking about faster digital loans. What I largely feel is that rather than working on that space, we should largely work on creating smart guardrails. We should work on creating smart pop-ups or triggers where the software, the technology used tells the funding partner or the lending partner that this is a no-go area, this is a no-go segment, this is a no-go age criteria, or this is a no-go kind of a triggers is something that I feel is what startups or fintech should largely work upon rather than just giving faster loans because I stay on ground, I meet a lot of farmers. No one largely says that give me a faster loan. The larger requirement is of going to the right place, and if you get deviated because there are sales officers, relationship officers who actually go and do this sourcing, right? Then if it can be with a partner or it can be with anybody else. So how about they get some kind of guardrails that you're possibly going into a no-go area or something of that sort. So I feel that is one area where I am on lookout for technology partners or fintech partners. So I think it is more about collaboration, and with the right technology partner or the right ground partner. I'll also give another example in the FPO space. So we are one of the largest banking space in the space. We have funded around 900 FPOs. Out of that, around 450 are through collaboration with ITC. So ITC floated FPOs or FPOs which work with ITC. So there, this technology collaboration, and obviously ITC being a big partner on ground, has again helped and help stitch this all around. So I think definitely collaboration and some kind of collaboration to help us go at the right place and possibly stop us from not going at the wrong place. Yeah.
Right. Uh, and I mean, on this, of course, engagement between fintech and legacy incumbents, traditional institutions is going to happen. The question is whether it will be a arm's length distance partnership, or do you see some sort of a deeper integration, some sort of a joint venture, and whether investors could also facilitate some of these, integrations.
Yeah. So yes, I think again, I think there has to be a more. I mean, it's still early days, but I think there is a need to be more deeply integrated than one-off partnerships, because I think for all parties you have to invest a lot. I mean, of course, as operators, Ankur and Akshay can comment better, but you invest a lot of time and energy in sort of bringing together or stitching together partnerships. So it has to be a bit deeper than a one-off kind of activity. And for investors, of course, we have portfolio companies across both spaces. So I think to the extent that we can facilitate partnerships within our investee group, we would be happy to do so. And I think that's the intent as well. Also, that should be the value add for investors. If we can connect, ultimately that's the limited value add that an investor can add to the company, is to connect the like-minded players.
Right. Okay. Just as a conclusion, what are the 2-3 things that you think, as investors and someone as a leading financial inclusion retail player, you want to see in the sector happening, or what do you think is a major, 2-3 areas where you would want to push the sector to make those changes, important changes?
Yeah, I think in general the sector has evolved to be extremely collaborative over the last decade or so that I've been around. So I think that is a huge positive, and I think perhaps not much specifically the sector, but I think from a regulatory perspective, a greater sense of certainty would be of a lot of help to everyone. I think while we have been extremely progressive in terms of fintech and allowing new models to develop, I think the manner in which some of the changes updates are made are sometimes detrimental to the sector. And also to the sector itself, I think it's important to keep our eyes and ears open for feedback from the ground and not wait for the regulator to speak up. So I think it's a bit of, let's say, two-sided effort, but I think that is necessary for people to be constantly on the vigil and quickly feed that feedback up to regulators or the powers that be to make those changes, and for the regulator to give stability and certainty on future for investors to invest in a certain sector with a 5-7 year horizon, and not look at unforeseen regulatory changes.
Can I? I feel that on the book size level, we see that the microfinance industry is growing, but unfortunately, the number of women participating is not growing with the same percentage. So obviously there are many challenges and many reasons to that, but I feel that what I want to see in near future is that more and more women are included, and that can be through obviously entry into new geographies, which are obviously difficult, and there would be other challenges to it. But by solving the on ground execution, the right products or the product mixes with help of some technology or ground partner, etc., I think that more and more people, once they also start get included into this industry, I think then the way the customer count and the volume, the amount also should increase with the same CAGR possibly. I think that is I'm most optimistic or looking forward to in this industry.
Ankur?
So yeah, I agree with my fellow panelists. Just a couple of more points. So since we deal with all kinds of institutions on the FS side, I think there are a lot of small NBFCs who are struggling to scale, who have been in here for a very long time. The segment is getting more tough to scale. The regulator doesn't want, like, there are too many small players, right? It's a game of scale, of capital, of economies. So it's very important to start shaping up as a larger institution than a promoter run kind of a business. So I think two things become very critical in that. One is adoption of technology and corporate governance. So both of them are critical from a scale perspective. So that is a mindset and thought process change, where a lot of the new NBFCs which are being set up are by professionals who ran large businesses, like people who have come from AU or may have looked at AU or worked with AU, for example, and similar other such MFI companies who are leaving these large opportunities and starting. So they know how a institution should work. But a lot of the traditional players do not understand the requirements of a potential lenders, especially if you want to deal with institutional investors. So there is a lot of consolidation that is yet to happen in that space. A lot of them are still not using technology enough. And that I'm not talking about only for MFI, even the traditional NBFCs. Like a lot of collection is still in cash. So a lot of those things will slowly have to evolve. Some people have a close-minded. Some people say, I've already taken 60-70% in digital collection. So you hear the same thing in the same week for similar size players. So a lot of these things will start consolidating over a period of time. And at the same time, we have seen that this liquidity, when it comes with a lot of splurge. And then at that time, everybody sort of forgets about these first principles of business and starts into the fray of competition, etc. And again, that leads to another crisis. So we have to learn, become better in that. Some of it can be regulated. Some of it you have to have your own discipline as an institution. But ultimately, it's all about, thinking and managing risk at all points of time.
Thanks so much. I think we are just extending our time a bit. Just concluding, so we gather that in order for the sector to grow further, it needs to continue to innovate, work a lot more on its governance structure, its management practices. Also, along the line, work on digital transformation. Most of the legacy incumbents will try and use the digital rails that are available, the digital infrastructure that is available, and would be ready to dock on to all the data sets that are available, learn how to diversify and use those alternate and proxy data, and a lot more emphasis back on responsible finance and social performance as a sector. With this, I'll just conclude this session. Thank you so much, everyone.
Thank you for making it a very enjoyable discussion, very fruitful and full of information. May I request you all to please join us front and center for a group photo. And we also have a small token. We would like to present it to you. I'd like the team to please hand over the token as they ascend from the stage. And ladies and gentlemen, may I request you all once again, please kindly remain seated. Members of the audience who are still standing at the back, may I request you all to please kindly take your seats. And we are very proud and honored to share with you all that this evening, we are very proud to welcome in our midst today, Dr. A.K. Sood, Deputy Managing Director, National Bank of Agriculture and Rural Development, that is NABARD. A very, very warm welcome to the honored dignitary. We are also privileged to welcome on stage for a summary of summit proceedings, Ms. Smita Premchandar, Secretary Sampark, And may I also welcome on stage Mr. Sudipto Saha, Head Financial Inclusion Access Development Services. May I request you all to please join us on stage. Please join me in welcoming them with a huge round of applause. A very warm and hearty welcome to Dr. A.K. Sood, Deputy Managing Director, National Bank of Agriculture and Rural Development. Once again, a very warm welcome to all of you onto the stage. May I first request Mr. Sudipto Saha to kindly present a bouquet of flowers and welcome the honored dignitaries. We extend a very warm and hearty welcome to Dr. A.K. Sood. It's our pleasure, sir, to welcome you here in our midst. We extend a very warm and hearty welcome to Ms. Smita Premchandar. It's a pleasure to welcome you here, ma'am. So, ladies and gentlemen, as I've already shared that she is going to share with us a summary of the summit proceedings, may I now request Ms. Smita Premchandar to kindly share with us the proceedings.
While I wait for also the slides to go up, the last session, I think, also speaks to how we come to conferences. I think many of us come to conferences to speak and to hear ourselves and to talk about what we do. And the number of people who stay back towards the end are the ones who have actually listened and who are really interested in listening to the end. So this to me is very special that at least 40, 50 people stay back. And today, of course, there are more than 40, 50. So thank you for staying. I'll start with Hindi because I had said last year that we actually now 21 years down the line, we have seen a lot of these conferences. We have learned from every conference, and those of us who come regularly, we have a sense of history and growth of the sector and the narratives that we've created and heard. And so the poem goes like this. देखते हैं हम अंधेरे से रोशनी को, चलो बैठें किसी दीपक की लौ के तले और देखें अंधेरे से रोशनी को, क्योंकि देखते हैं हम नेपथ्य से मंच को. Right? So if we are ourselves sitting back a little bit in the shadows and looking at what's happening on the stage, the learning is maximized. And I think for me, it's really important to say Access has given me this opportunity to sit, reflect, listen, and share with all of you those reflections at the end. So thank you to Access. But of course, I've not done it alone. And every time again, thanks to Akash and Sudipto, Vipin, and the Access team, we've had 10 or 12 people doing this note-taking and learning. So, where are the slides? Where's Tanya? Can I have the slides on? Okay. Okay, thank you. All right, so we had Ananya, we had Vinita, we had Kora, who's not here today, we had Kavita, Shomita, Anupam, HC, Muttu, Prashant, and Vishal. Can you all stand up, please, wherever you are? In the hall, that can we give them a round of applause? Thank you for all of us working together for, capitalizing our learnings and showcasing them today. So what have we done in this conference, in this summit every year? We create learning spaces and we create documentation spaces as well. We share documentation. Access brings together the key stakeholders in the sector, Every single time, the most important players are there, and every single time, the people creating impact on the ground or scale or in policy influence are honored. We've seen that. We bring together a global perspective. So there were experiences this year shared from India, Africa, to an extent, Latin America and Bangladesh, and some from the States. We got multiple perspectives on different topics, so I'm not listing all of them, just some of them. We heard the story of financial inclusion from different perspectives, people starting from 1951 and up to people starting from 2014, different slices of history. The story of growth, the risks that we face now and before, data availability, access to finance, sharing of data, use of data, protection and safety issues, the digital infrastructure. There was a whole lot of sessions around that. There were 2 sessions around climate resilient agriculture, one especially for women. There were discussions on non-farm sector, on wash and water, and several others. There were also MSMEs. There were also actor perspectives, so we had a whole range, government, private sector, banks, NBFCs, SFBs, credit bureaus, a whole range of institutions. We also had perspectives from cooperatives and from international agencies. And the last session, again, which was also from institutional investor perspectives. What about the gender lens? We have continued over the last 21 years to become more and more predominantly male narratives being presented and institutional perspectives being presented, sometimes women's perspectives, but by and large these are relegated to the second day, to the afternoon, to the parallel sessions, and we've moved away from discussions on women's issues and women's perspectives in the plenaries. So this is something I'd like you to flag and think over, because this is not just a reflection of the conference, this is a reflection of the way we are in the industry and how we are thinking and where we are taking the sector. What about the issues of agreement? There was a whole lot of issues of agreement. I've just written a few. Phygital model works better than only digital models. Was very clear. A lot of focus on digital, but you need phygital to counter the risks that the industry is facing today and to meet people's needs. Then understand better the challenges and difficulties that women face and provide customized solutions. Collaborations and partnerships came up in every single discussion. And this is really an underscoring of where we are in the industry today. Further growth, further risk mitigation, further safety of future scale-up cannot happen without very strong collaborations. Impact, there were sessions on impact where the need for, and a lot of quantitative studies were also presented, but what was also underlined was the need for qualitative research, which is context-specific and subjective longitudinal data, which is not only with the proving impact mindset, but also the improving impact mindset, which means understanding people's needs, especially women's needs, and offering financial products and non-financial services to meet those needs. This was flagged also. I think one of the things that we should flag is that it came out very strongly that we must reassess now the theory of change of microfinance. So the theory of change that the dominant narratives give us are not exactly working out on the ground. And we don't tend to say it in the first session of the first day, but by the second session of the last session of the second day, these things are being discussed, and it comes out that we do need to review, reassess how microfinance is used, how enterprise credit is used. Many of the institutions also said how important loan utilization checks are and how important the traditional group lending methodology continues to be, because it allows to analyze risks, allows to question. the current narratives. So we must stay alert to that as an industry, I think, and not become complacent. Also, the SHGs, JLGs, individual lending, micro and small enterprise finance, these continue to be different models. And sometimes when we are talking, we do not necessarily differentiate enough. So, and when we do not differentiate enough, then we forget that they need not always be collaborative. They can also be competing models, and they can have completely differential impacts. Also, women's empowerment, I think there was a very clear message that it is still a relevant question or not. Let's debate that. And there were impact studies to show and question whether long-term makes a difference. Some studies say long-term access to dynamic loans makes a difference, dynamic incentives make a difference. And some studies say no, they don't. They do not influence household bargaining power because the patriarchy that we live in different contexts is much stronger. Is the loan used for income generation? What are the terms on which money is given? What are the sources from which the money comes? All this is important. And they came up in some sessions, not in all. How about women's access to microfinance? There were in some sessions a statement, more than one statement in 2 or 3 sessions, talking about reinforcing the fact that there should be a business case made for women. And I'm really thrown 30 years behind. 30 years ago, we were saying, are women bankable? Are poor women bankable? Are poor people bankable? And if today we start with the same questions, then it's really for us to think about, is it still to be proven, this business case? Women have proved, no, they provide all the information, they are easy to discipline, they sit in SHGs, they come to JLG groups even if JLG as a model is falling out, they still repay well, they spend on family, right? But then the moment you're moving out from the SHG and your business is growing, there's a huge gap. Individual lending drops as soon as you move out of the SHG concept, and then you move further towards small, towards nano, small, and medium, and the percentage of women, loans to women enterprises drops hugely, right? I think there were issues, people kept mentioning women have low access to information. They also said women's capacities should be built, right? But only one, and it was interesting that she was from Ghana, the person who mentioned it. She mentioned the concept time poverty. Yeah, women do have time poverty. They just don't have this. We're still talking about gender-based triple roles. They still have lack of asset ownership, and especially land and physical assets as collateral. And these are things for which microfinance institutions per se don't have solutions. You have to work outside the microfinance institutions. Okay, so then there were partnerships I've already spoken, and designing products. We need to listen to the current research that either the Pondicherry Institute is bringing up, or Sharda Gopal and people like that who are activists in the field are bringing up. We need to listen to that. There's a big discussion in almost every session on data, technology, AI, and the key points were that there's data fragmentation across the sector. We need to use data for financial inclusion, for improved credit assessment, for improving borrower capacities, etc. But we need for that to develop the ecosystem a little more. Lots has been done, but lots more needs to be done. And AI is as good, as ethical, as gender responsive as we design it to be. This does not happen automatically. there was one comment which was very strong on having forbearance and tolerance in the use of data. So what they were saying is don't harm people when you use the data. Don't immediately make their accounts inactive and don't immediately classify them as defaulters, but have some patience and wait for a while before you act, even if your data tells you that people are not paying, because understanding the why is very important. Okay. Digitalization of land records is a priority area, and and build data sets only if you have benefits. This is the last slide, which was around climate resilience. Again, a lot of work is needed in terms of research, in terms of building a robust taxonomy and developing innovative green finance solutions, as well as working with the community. So I will stop here. This is not a summary of every session, but we have tried that between the 10 or 12 of us to bring you the key points, and I hope it helps you to think through some of the major learnings that you had in these sessions. Thank you. Thank you.
Thank you, ma'am, for sharing these learnings with us. It now gives me great pleasure to request Dr. A.K. Sood, Deputy Managing Director, National Bank of Agriculture and Rural Development, to kindly articulate his thoughts. Please welcome with a round of applause.
So, good evening to all of you. So, I think as we are coming close to this event, so a lot of things have already been spoken about various sessions and the learnings that we have taken. See, as the financial inclusion space grows and the ecosystem changes, but still there are many things that need to be done. One of the biggest problem in FI is that we are taking a very micro view of things. Say, for example, there are issues in terms of targeting certain geographies. So if I say northeastern region or central region, they are not as much financially included as other regions of country. So there are issues in sectoral targeting of the regions of the country. There are issues in institutional capacities to run FI programs. So we need to do a lot of initiatives in these. So sectoral, for example, bioman is one area, targeting of bioman, maybe agriculture or non-agriculture. And if I talk of agriculture, there is a big chunk of people who are still uncovered by formal institutional setup, that is the tenant farmers, which take up around 25% of the cultivated area of the country. So these are some of the segments which still remain out of formal financial system, though they are accessing from informal sources, which is predatory in nature, which is usurious, and the sectors that we are dealing, they are not that profitable to make that much of dent. So I think in terms of the institutional capacities, NABARD has also undertaken certain initiatives. Only recent ones I will tell two or three. One is the account aggregator as a service to the rural financial institutions that we are doing actually. It is a work in progress. So basically the purpose of this is setting up of a common infrastructure for use by the RFIs. And it will act as a gateway for the cooperative banks particularly to onboard the account aggregator framework, extending digital financial services to more entities. That is one initiative as an ecosystem provider that we are taking. One initiative that we have taken in the digital space is eKCC portal along with the RBI Innovation Hub. Its pilot is ongoing in 2 states of Andhra Pradesh and Odisha. So it's basically the digitization of the loan origination process for Kisan credit card is happening. We are running with SBI and one cooperative bank, and then it will be extended to regional rural banks and cooperative banks going forward. So basically the purpose of this is that it integrates various data points and provides enabling environment for all digital journey for extending the loans. Then there is one more initiative which is shared services entity for the cooperative banks, and RRB is in fact in the later stage. So these cooperative banks, they are something which do not have that much of financial strength to take up technology absorption and many such initiatives. So without which they are losing customers, because now the customer experience is something which is very, very important. So we have got regulatory approval in this, and we are going ahead with this. So once this initiative is implemented for cooperatives and maybe for RRBs later on, then this will provide a level playing field for these institutions, and it will be a very good initiative for the FI space. Then for regional rural banks, we are doing automation for Jan Suraksha schemes. For commercial banks, this has already been done. For RRBs, this was yet to be done. So we are doing this, and I think these are some of the most recent initiatives that we have been, apart from the traditional things that we are doing. So as we conclude, I think several key themes which emerge and which call for action is one is the collaborative partnership. So building strong alliances among governments, private entities and civil societies to accelerate impact. It's a given fact that no single entity can do work it's a huge work to be done. So we may have to collaborate, we may have to come together. That is the need of the hour. Then policy advocacy is another area. Innovations at scale. So scale is also important. We have felt it. And use of technology to bring scale. We are talking of FPOs, we are talking of SHGs. So I think that is the way forward to go. But how to infuse technology in that is something we need to do. Then is sustainable growth, embedding resilience in the financial products and ensuring that they are accessible to the marginalized groups. So these are some of the key takeaways that I think we all should take. But our job does not stop here. I mean, just discussion and all this, it doesn't stop here. It rather begins, I would say. So the voices that we have heard and the solutions that we have discussed, they must be taken to the boardrooms, have broader discussions in the policy corridors. Together, we have a shared responsibility to ensure that the financial inclusion that we are talking about is not just a goal, but an everyday reality for millions. So I think with this, I end my speech, and I hope that the discussions which we have gone through during the last 2 days, we take some initiative on this. And I was discussing with the Sharma ji that together, Access Development and NABARD, we will definitely like to work together and maybe take forward some of the discussion points going ahead. So thank you so much for giving me this opportunity.
Thank you, sir. It's been a privilege and an honor to have you here with us. We express our sincere thanks to the esteemed guests seated with us on the dais. May I request Mr. Sudipto Saha to kindly present a small memento to both of our esteemed dignitaries. We thank Ms. Smita Premchandar. Thank you, ma'am. And our heartfelt thanks and gratitude to our honored guest, Dr. A.K. Sood. Thank you, sir. And now may I invite Mr. Sudipto Saha to kindly propose the vote of thanks.
Good evening, everyone. So with that, we come to the end of the 21st Global Inclusive Finance Summit 2024. So while Smita has summarized very crisply the discussions as well as whatever happened in the last 2 days regarding the Indian financial inclusion sector and the happenings during in the sector. So I think she has summarized it very well. We will be coming out with a report of all the details and summarizing the entire session-wise plans. So at Axis, we are particularly overwhelmed with the response and participation from all quarters this year. Sponsors for supporting the summit, technical partnerships, companies wanting to put up stalls in the knowledge fair, as well as delegates from diverse set of organizations specifically for the participation. At the end of the 2 days, it is most appropriate to thank a host of stakeholders without which we couldn't have done this summit. So firstly, we are thankful to the Department of Financial Services, Ministry of Finance, Government of India, who has been the co-host for the second year in a row. Also deeply appreciate our partnerships with various partners across the 2 days of the summit. Our principal partner, BMGF, Bill and Melinda Gates Foundation. Special thanks to Pawan, Prabir and Pradeep, who has been very supportive, very cooperative in developing the session plan, the themes, topics, as well as the speakers under each of the themes which we had suggested. MasterCard, IDFC First Bank. The core sponsors, SIDBI, NABARD, Credit Access Grameen, State Bank of India, along with HSBC. Co-sponsors, Annapurna, AU Small Finance Bank, Ujjivan Small Finance Bank, Equifax, Water.org, Black Soil, and Northern Arc. So, I would like to place on record special appreciation to HSBC for supporting us for 16 years for the Inclusive Finance India Awards. Thanks to knowledge partners Rabo Foundation, Better Than Cash Alliance, and IIM Ahmedabad. The gender track partner WWP, along with 9 technical partners who helped us work on various themes. 15 associate sponsors, quite of which were new, who had come on board this year, but most of them have been supporting for the last 5 years or so. We are grateful for the speakers, not only from India, but international speakers who spoke across 23 sessions over the last 2 days of the summit, sharing their views and perspectives on various themes and sub-themes. Special thanks to the moderators of all the panels for working hard with them and bringing the best out of the speakers. I would also like to mention the work done by our accounts partner, Small Town Brandits, Aage Se Right, PR agency and online streaming partner Dreamcast for supporting and backstopping the Summit Secretariat. I'd like to thank the authors of the Inclusive Finance India report, Mr. N. Srinivasan, Girija Srinivasan, Gaurav Gupta, Indradeep Ghosh, Mita Premchandar, Dr. Jay Seelan, and most important of all, Ramesh Arunachalam, the editor of the report. We hope that the summit has been a useful platform for learning, sharing, as well as network. And we thank you for attending this summit annually. Your participation and engagement encourages us to continue to put required energies in organizing the event year after year. Thanks to Mandeep, our wonderful MC, for a charming facilitation. Thanks to Numec Events, our event managers for their hard work in helping organize such an event, big event, and also to Hotel Ashok team and management for providing the required support. Not to forget my team as well as our team in Axis, comms team led by Tanya, Ravi, Sonali and Shubham, accounts and admin team led by Subir, Shilpa, Nitin, Ajay, Ramesh, Kapil and Sanjeev. Entire Axis team coming in for the last 2 days, not only supporting the summit for being the MC, point of contact as well as rapporteuring. And to our CEO, Mr. Vipin Sharma, who provided the technical guidance and support and also encouragement and faith in me and my team. Last but not the least, my team, my 2 hands, Akash Srivastav and Satyan Kumar. Please come on stage. Thank you very much for all the support provided. As and when required, 24 hours, whenever I used to call them, they were available. And so thank you all. Thank you once again. And looking forward to meeting you all next year. Thank you very much. We'll announce it. Thank you very much.
Thank you all once again. Just a gentle reminder to please do remember to carry all of your belongings with you on your way out. Thank you.